we've had many lessons from the crisis, and I think those lessons, some of them, are very specific to Compartamos. Some of them are very specific or applied to the industry itself. But clearly, 2009 was a very, very important year. When we started 2009, and actually when 2008 was ending, we had three main concerns. One was to protect the quality of our assets. That was number one. Second was funding. Part of the growth of Compartamos has been the story of having access to financial markets and specifically to wholesale credit markets. We've been very slow, as I've mentioned before, on our own goal of being a fully local, let's say, financial intermediary that has massive funding coming from local deposits. So lacking that strength, because we do realize that's one of the major, I think, lessons through this is that you need to have that to be strong and stable. One of the things that concerned us was, were we going to be able to fund our growth, and not only our growth, but really our operations, our day-to-day operations through a period where the credit markets just disappeared. And lastly, I think in the case of Mexico, there was also huge debate on financial regulation through that period, and specifically in things like interest rate caps for credit cards, which had become an issue in Compartamos, not specifically on microfinance, but clearly a pressure in the electoral year, a pressure on increasing financial regulation to all banks. And that was also something that was, again, very specific to Mexico, but that played out at the same time the whole 2009 crisis. On point number one, credit quality. One of the things that we had preached for many, many years was these large-scale macroeconomic events don't affect the same way a microfinance clients. And I think that part of what 2009 did was it really forced us to think about why that is and not just say it, right? So try to really understand what is it about microfinance, working capital micro-entrepreneurs, specifically, that makes this resilient. And I think it had to do, again, part of with our own policies and way about doing things and protecting the client, but also about things that are natural to that segment of the market. One of them was, of course, what we saw with our clients was that they were affected. Their businesses, whereas they used to grow, typically started to shrink. So if they were selling 100, they were now selling 80 or 85. But still in a very flexible environment in which we're looking at $350 of working capital, very, very small loans, especially very small businesses for the Mexican context. So basically very different from what happens to a SME, for example, when 15% or a 20% drop in sales can actually bankrupt a small firm because of the fixed costs that they have. What we saw was not only the demand remained there, but actually fairly large increase on demand for our products. And we also got to see that we need to be very, very responsible, not only, again, in pushing money out the door and trying to protect the client, but also to be very, very focused on collection. Traditionally, for almost 20 years, Compartamos had been in its incentive schemes for loan officers measuring portfolio at risk above 30 days. And as of 2009, we started measuring above 8 days. Credit quality did suffer through 2009, and there were mainly two reasons. One was that, yes, the wallets of our clients at some point were pressured. So when you look at all products through the portfolio, they had some kind of impact. But on the average, NPLs or credit quality suffered more because of a change of the mix of the products. Again, I've mentioned before, house renovation loan grew from about 5% at the beginning of the year of the portfolio to about 12%, and that's a riskier profile product than the village banking. So it was more a feature of, or of the mix of the portfolio. But clearly, it was a concern. Still, it is a concern because we believe that credit quality is very, very important in order to have a strong institution. In terms of funding, again, credit markets collapsed, and at some point that was, again, a very big concern. We were still not, and we're still not ready to massively deploy a savings product that could offset that. Two things happened. One, I think, and again, we never saw this coming, just like the rest of the world never saw this coming, but I think a few key features of our balance sheet came into play really nicely. One was our high capital rate. And often we're criticized because of the fact that we've not been much more aggressive in leveraging the balance sheet in Compartamos and the effect that could have, for example, in pricing. But again, we've always sustained 30% growth in our assets year over year in a market that where we still see that debt lending, even though there is volumes of money, there's still quite a bit of sensitivity to the risk. We've always been very, very conservative in the way that we leverage that balance sheet. So having 50 or 40% capital rate was huge in this 2009 because it enabled us to have that strong capital base to then continue to attract other debt. And also the profitability of the company was a key part in the sense that we were able to grow 30% without actually having to increase a lot of our liabilities. In fact, we had ended 2008 with a very significant cash balance, and again, just trying to make sure that we had enough funding for the growth in 2009 and to continue our operations. And having that strong balance sheet was key to having access to that. So the three preoccupations, one was, credit quality, we came good out in that. Funding was there, and again, the key lesson in funding is you can't rely on the wholesale credit markets, 100%. So you need to diversify your funding, and you need to be really a deposit-taking institution for it to be solid for the future. And lastly, again, all this electoral debate that came through in the first half of 2009 in Mexico, talking about other types of regulation and even interest rate caps. We engaged like we've never done in the past in talking to lawmakers, regulators. They really made us think through our arguments of why things are the way they are and what kinds of products we're servicing to what type of client and what the costs are there. And I think it was a learning process for everyone. And again, aside from the fact that most of that discussion and at some points was strictly political and kind of perception driven, I think it allowed both regulators and lawmakers to really understand what microfinance is all about and why they want to build an industry that's competitive and that allows people to serve the client better with better products at a better price, as opposed to artificially trying to set interest rates and regulation that could very well dampen the ability of providers to serve those markets. So again, a very intense year in that respect, but also I think a very successful one.